leave monetary policy to the markets.
Okay, so Dr. Frank, there has been a lot of discussion about this almighty drop in the markets. What can you tell us about it?
Well, it's continuing a trend. If we look at this graph for 2015, we see that we've had a continuous decline, or essentially a continuous decline in earning growth. And we see that once earnings season is passed, the markets have generally declined. And for the moment, we have earnings even below 1.8%, so we can expect a continued decline in the markets. If we look at it from a longer-term perspective, we're at the yellow point, okay, and we can basically say that A, E, and D are unlikely to occur, so we have two options. It's either going to be B or C. B implies that we're going to have an increase in the long-term growth estimates for the S&P 500, and that's basically going against trend since S&P earnings have actually gone down. If earnings stay about the same, we can expect a 20% drop in the markets. But if we continue to get a reduction in growth estimates, then we could see a drop as much as 50%. So I would say that despite the fact that we've dropped quite a bit in 2016, my view is that if we follow the statistics, we can expect to see even a larger drop.
So it may be that we ain't seen nothing yet, but when you think about the global economy, Dr. Frank, how are you feeling about it?
Well, I really feel that we started a global recession. Actually, I think it's going to be a global depression last summer when we had the crash in China. And we can see a lot of countries, for example, that are dependent on trade with China. For example, Australia and Brazil are already in recessionary territory. And we're seeing that for Japan and Russia, and it's very likely that the numbers for the fourth quarter in the United States will be very, very low, or maybe even in negative territory, which means that we'll be pretty much in a global recession for sure in the middle of 2016, and in my view, toward 2017. And we have to understand is that the world economy really can't afford to have a global recession. Okay, take for example what led to the boom in the United States, which was the shale oil industry. We have to realize that most of the gains in employment were basically in shale oil states like Texas. Okay, but people have to know that shale oil companies need about $65 a barrel just to break even. So with oil prices at $30 a barrel and maybe going as low as $10 a barrel, a lot of these companies are going to go bankrupt. Now you're going to say, well, that's only shale oil companies. But we also have that a lot of banks have lent $1 trillion to the shale oil industry, and we're already seeing some, key banks in these territories, like in Texas, are having significant difficulties with liquidity and are looking for the Fed to help them out. And that's just the shale oil industry. We also have, for example, the situation in Italy, where we have the government has a debt to GDP ratio of over 130%. Its banking sector has non-performing loans have gone from 5% in 2010 to over 15% today. Okay, so they're in difficulties also. And in a global recession, we basically have a significant amount of bombs that could go off and affect the world economy, bring us from a recession to a depression.
Okay, absolutely. I mean, a lot of definite things to be worried about. But if we think about central banks, FOMC looked to be keeping their options open. RBNZ held pat. South Africa just hiked a little bit. But what do you think central banks and indeed governments should try to do to avoid these problems that you're talking about?
Well, the problem we have in 2010 is that we wanted to solve a debt problem with more debt. In other words, we have economists believe that the economy is a car and that the interest rate is the gas pedal. So you raise interest rates to slow things down and you lower interest rates to make things go faster. Okay? This is a total misunderstanding of what the role of interest rates in an economy. You have to understand is that interest rates are a price. They're basically the price of time preferences. And the key thing about interest rates is they align output with society demand across time. So in other words, we have output today, but we also have output across time. And interest rates are key in aligning the society's demand with the output that society wants. So if you interfere with interest rates, you basically get a divergence between what society wants and what society is producing, okay? And the longer you interfere with interest rates, the greater this divergence will be, and the greater will be the adjustment to realign society's demand with output. And I'm afraid that we've interfered with interest rates for so long that we're going to have a significant adjustment to get us back to the point where we can have a sustainable growth in not only the United States, but worldwide. So my advice to the central bank is stop fiddling with interest rates, go on vacation, go to the Bahamas, and leave monetary policy to the markets, okay? And stop printing money. Okay, that's basically my fundamental advice for the central banks and what monetary policy should be.
Okay, well, Dr. Frank, thank you so much for coming in and chatting to us. It's always a pleasure. Thank you for your time.
Thank you for having me.
Okay, well, that's all from Dr. Frank and myself in this very special exclusive interview on Dukascopy TV. Thank you for watching and goodbye.